Looking to boost your passive income and secure your financial future? Well, you've come to the right place. In this video, we'll unveil the 7 best monthly dividend stocks with high yields, handpicked for 2023. Get ready to unlock a world of lucrative opportunities that will supercharge your wallet. Monthly dividend stocks are a game changer when it comes to generating recurring passive income. Imagine receiving consistent payouts perfectly timed with your expenses. It's the ultimate win-win situation. And today, we're going to show you exactly how to make the most of these dividend powerhouses. Now, not all monthly dividend stocks are created equal. We've done the heavy lifting for you, sifting through countless options to bring you only the creme de la creme. Our top picks not only boast impressive yields but also demonstrate steady growth, a winning combination that sets them apart from the rest. So, if you're on the lookout for the best stocks to invest in 2023 and craving that financial security, you're in for a treat. Prepare to discover a carefully curated selection of dividend stocks that will elevate your investment strategy to new heights. But wait, there's more. We know you're itching to get started, so without further ado, let's dive straight into the world of monthly dividend stocks and uncover the gems that will revolutionize your portfolio. Get ready to seize the opportunity and make 2023 the year of financial abundance. The number one of our list is EPR Properties. EPR Properties, a real estate investment trust, specializes in experiential real estate holdings such as movie theaters, eat-and-play venues, ski resorts, and gaming facilities. By signing triple net leases with venue operators, EPR Properties ensures that tenants handle insurance, maintenance, and real estate taxes. The COVID-19 pandemic dealt a blow to experiential real estate, forcing many facilities to temporarily close or operate at reduced capacity. Consequently, EPR Properties suspended its monthly dividend in 2020. However, as the world slowly reopens, most tenants have regained their footing and witnessed a surge in demand for immersive social experiences. While the majority of EPR's tenants have rebounded, it's important to note that movie theaters, the largest segment of their business, continue to struggle with revenues well below pre-pandemic levels. The bankruptcy filing and subsequent reorganization of a major tenant, Cinemark, owner of Regal Theaters, added to the challenges. To mitigate risks associated with the movie theater industry, EPR's management is actively working to reduce their exposure. Although box office revenues are improving, they still have a long way to go before reaching 2019 levels. While EPR aims to navigate this transition while maintaining its dividend, it's essential to acknowledge the inherent risks involved. In summary, EPR Properties faces the ongoing challenge of supporting its dividend amidst a changing industry landscape. By diversifying away from movie theaters and capitalizing on the recovering market, EPR seeks to sustain its financial strength and deliver value to its investors. The number 2, Agree Realty. Agree Realty, another reliable REIT, is known for its recurring rental income, making it a favorable choice for monthly dividend stocks. This company specializes in freestanding retail properties secured by triple net leases, primarily catering to essential retailers such as grocery, home improvement, dollar stores, and drugstores. These sectors are less vulnerable to e-commerce disruptions or economic downturns, ensuring a stable rental income stream to support Agree Realty's dividends. Having transitioned to a monthly dividend payment schedule in January 2021, Agree Realty boasts an impressive track record of dividend growth. Over the past decade, it has achieved a compound annual rate of 5.5% in dividend increases, although more recent growth has moderated to 3.8%. However, with ongoing portfolio expansion, the upward trend is expected to continue. In 2021, the company acquired a record $1.4 billion worth of properties, and while growth has slightly moderated, management anticipates a total of $1.2 billion in acquisitions for 2023. With a robust portfolio growth strategy and strong tenant relationships, averaging over 13 years in lease term, Agree Realty is poised to remain a reliable monthly dividend grower for years to come. Number 3, Gladstone Commercial Corporation. Gladstone Commercial Corporation is a diversified REIT focused primarily on net leases of office and industrial properties, each representing 48% of its portfolio. Additionally, it holds some retail and medical office buildings, with a strategic emphasis on secondary markets offering higher investment yields. Gladstone Commercial has built a reputation for stable income generation. However, its streak of consistently increasing or maintaining monthly dividends above the prior month's level came to a halt in 2023. The company implemented a 20% dividend cut due to underperforming office properties and initiated efforts to offload unprofitable assets. While another dividend cut cannot be ruled out, management has stabilized the business and shifted focus towards strategic acquisitions of high-demand industrial properties. Additionally, the company is ensuring long-term tenancy in its office properties. These measures reflect a proactive approach to strengthen the portfolio and rebound from recent challenges. Number 4. LTC Properties. LTC Properties is a healthcare-focused REIT, specializing in senior housing and skilled nursing properties secured by triple net leases, mortgage loans, and other cash-generating investment structures. This investment strategy provides a relatively stable income stream to support LTC Properties' monthly dividend. Undoubtedly, the senior housing sector faced significant challenges during the pandemic, affecting LTC Properties tenants. Some struggled to meet rental obligations, resulting in bankruptcy filings. However, the REIT's financial resilience enabled it to navigate the storm by offsetting lost income through new investments, maintaining its monthly dividend. Nevertheless, LTC Properties has not been able to increase its payout since 2016. Looking ahead, LTC Properties benefits from favorable long-term trends driven by the projected doubling of the American population aged 65 and older by 2030. However, operating in a demanding industry requires continued tenant stabilization and strategic partnerships with top operators to fully capitalize on these tailwinds. Patient investors can currently enjoy a yield of almost 7% while waiting for potential rewards. Number 5. Realty Income. When it comes to monthly dividend stocks, Realty Income stands as the front runner. As the monthly dividend company, it has an impressive track record of over 635 consecutive monthly dividend payments as of May 2023. Since its IPO in 1994, Realty Income has increased its dividend over 100 times, achieving a compound annual growth rate of 4.4% and providing more than 25 years of consistent dividend growth. Despite catering to relatively slower growth businesses among its tenant base, Realty Income has significant growth potential. The company estimates a global market opportunity of $12 trillion for the single-tenant net lease real estate it targets. This presents a substantial opportunity to consolidate tenant properties under its ownership, fueling further payout growth and rewarding patient investors on a monthly basis, year after year. Number 6. SL Green. SL Green, the largest office landlord in New York City, has long benefited from owning highly sought-after Manhattan office buildings. However, the pandemic and evolving work dynamics have presented challenges for the office REIT. To adapt, SL Green's management is strategically selling less desirable assets and focusing on tenanting vacant properties at competitive rates to drive profitability. In 2022, SL Green utilized the proceeds from asset sales to reduce its debt by 9%, repurchase stock, and position itself for future growth. While the company had to lower its monthly dividend by 13% at the beginning of 2023, these proactive measures indicate a commitment to navigating the evolving office environment. While there is some fluidity, the worst may be behind SL Green. Investors with higher risk tolerance may find it an intriguing turnaround opportunity. Number 7. Stag Industrial. Stag Industrial, a focused industrial REIT, specializes in owning warehouses and light industrial facilities that are in high demand. The pandemic's impact, including increased e-commerce adoption and supply chain challenges, has propelled occupancy levels and rental rates, generating consistent rental income for Stag. Driven by its ability to continually expand its portfolio, Stag has added over 400 properties since its IPO, surpassing 500 buildings in its portfolio. The REIT maintains its growth trajectory by targeting $1 billion to $1.2 billion of annual property acquisitions. This, combined with rental income growth, allows Stag to steadily increase its monthly dividend, albeit with moderate raises. The recent increase was under 1%, while the payout has risen by 3.5% over the past 5 years. Now that we've explored these 7 high-yield monthly dividend stocks, it's time to wrap up our discussion and provide some concluding remarks. So, let's recap the key takeaways and considerations before we conclude. In this video, we delved into the details of each of these stocks, highlighting their unique characteristics and potential for generating passive income. From real estate investment trusts focused on experiential and essential retail properties to healthcare and office-focused REITs, these stocks offer a diverse range of investment opportunities. However, it's important to remember that investing in the stock market carries inherent risks. Market conditions can change, and the performance of these stocks can fluctuate. It's crucial to conduct thorough research, diversify your portfolio, and seek professional advice to make informed investment decisions. Thank you for joining us today as we discuss the 7 best monthly dividend stocks with high yields and provided some important considerations. If you found this information helpful, don't forget to like and subscribe to our channel, Healthy Wallet, for more valuable content on investing, personal finance, and wealth creation. We value your feedback, so please share your thoughts and suggestions in the comments section below. Let us know if there are any other topics or specific stocks you'd like us to cover in future videos. Remember, building a healthy financial future requires knowledge, strategy, and wise investment choices. Until next time, stay financially savvy and keep growing your wealth. Take care, and we'll see you in our next video.